I'm Jessica Minton for IB Times TV, and joining me today is Scott Carter, who's the CEO of Lear Capital. Now, Scott, it's so great having you here today with us.
Thanks for having me.
Now, obviously, the big talk this week, we have that Fed two-day meeting on Tuesday and Wednesday, and there's always talk, when is the Fed going to taper? And obviously, they are data dependent. Do you think we actually will hear anything new from them at this meeting?
I do. I think the Fed will have to give us a stronger message that things are improving, that they plan to taper in 2014. It might be sooner than what maybe people were thinking before, but I don't believe they're going to taper in December. I think that you have a Fed that's very cautious. I think you have a new Fed chairman that's going to be the last thing she wants to do is upset the apple cart right off the bat. So I think that they'll give us a strong message that the economy is improving, things are looking up, we're going to taper, just not yet.
And we have Janet Yellen obviously coming in January. Is there ever a time period that is too soon to taper or too late to taper when it comes to QE?
Well, she's been pretty clear that she's a dove. And I think that she'll wait as long as she can on tapering. I think that she likes these creative stimulus packages. I think she thinks the economy is a little bit weaker. And I think she'll be very deliberate and very slow in wanting to pull back tapering, if you will, or pull back the quantitative easing and see that bond yield go up. So I actually think when she gets in the chair, they're going to come up with reasons why tapering should be later and not sooner. I could be the lone voice here. Everyone's talking taper. I think that they're in a tough place. I think economically things are not as strong. I think she knows it. I think her conditions, or if you will, her leaning is to be a dove. And so I think that you're going to see tapering come in later in 2014 than earlier. But I could be wrong on that, but that's my view on her position.
Now, looking at gold, what exactly is the difference right now when we do look at the physical market versus the paper market?
Right, there's a huge difference. The paper market is so much larger than the physical market. There are basically 40 ounces of paper gold for every ounce of physical gold. So the pricing, if you will, of gold is driven more by the paper market, by COMEX and the futures contracts, than it is by the physical market. The physical market is actually very strong. The physical demand by central banks and by institutions and individuals is up over 30%, but you wouldn't know that in the price. So there's a disconnect, if you will, between the physical demand or desire and what we're seeing in the paper markets. That will come to parity at some point in time. It's just not there yet.
When we look at the COMEX, obviously from January until now, you look at inventories and they're just dropping so much. Why is that? What exactly is going on, and where do you think all this gold is going?
Well, there you have the difference between physical and paper market. There are a lot of entities that actually want to take physical possession. So what you have is when they put in their ticket and say, I want my physical gold, COMEX has to come up with that physical gold. So the inventories get depleted. But then you have contracts, paper contracts that don't take delivery that are holding the price down. So what you have is the physical delivery is declining inventories, and over time, as those inventories go lower, then you see what they call backwardation. Basically, you have to pay premiums to get gold into the market to make physical delivery. So COMEX is at all-time lows on inventories. They'll have to go back out into the market to buy gold to meet the demand, if you will, or those entities will, and that's when you see the price increase.
Looking at China, there's been a lot of debate about if they're hoarding gold, what is going on there. What are your thoughts on China right now?
Right. Well, China, as a superpower, wants to have more gold in their reserve currencies. Right now, if you look at the U.S., Germany, Italy, France, 75% of their reserve holdings are gold. If you look at China, it's 10%. So China and Japan basically have U.S. dollars as reserve currencies. So China has been on a huge push over the years to get more gold so that they can back their fiat currency, their yuan or the renminbi, with physical gold. And I think that that's why there's this huge appetite to have gold to basically stabilize their currency.
When you look at the U.S., obviously the reserve currency of the world, and what's going on with China, is there a fear of what they are doing with gold and how they are hoarding it?
I think we're a bit asleep here as the U.S. I think what you have is China trying to strengthen their currency, and the U.S. is basically allowing it to happen. And I think the U.S. is devaluing the U.S. dollar through all its money printing, and China is increasing the yuan. And there will be a point in time, worst case scenario, where the world says, we don't want just the U.S. dollar as a reserve currency, we want a basket of currencies. We want the yuan, we want the euro, and we want the dollar. And I think that that's going to be a negative for the U.S. and its financial power in the world, if you will.
Now, when we look back to the 1970s in Nixon's administration and they suspended the gold standard, obviously we are not back on it, but how exactly did the events then impact what's going on today with gold?
people realize that Nixon's decision over a weekend in August in 1973 was probably one of the biggest financial decisions that ever took place. There were no hearings. Congress didn't debate it. It was just basically an executive order by a president over the weekend. And what's happened since that, basically, is that the dollar is no longer backed by a hard asset, gold. So we've had this proliferation of money printing without any pause whatsoever that's taken us to a very small debt to over $17 trillion of debt. I think that impact has been profound. Those that are supportive of it would say, look what we've been able to do. We've smoothed out recessions. We've been able to expand the economy. But those detractors would say, you've got to have a dollar. A dollar today should buy a dollar's worth of goods tomorrow. And if we're declining in our buying power, then we're not doing the right thing as a currency. Gold, whether you love it or hate it, it was the plumb line to determine a value of what you can buy and not buy. And we've lost all sort of connection to that over time. Whether it should be gold or not, currencies should be stable, and they're not today.
Do you think we'll ever be able to go back onto the gold standard?
I think that's a long shot. I think what you'll see is the world leaders saying we need a basket of currencies. Maybe it comes out of the IMF. Maybe they use the special drawing rights of the IMF and put in other currencies that's a basket of currencies that devalues, if you will, the influence of the US dollar and creates more of a stability. As I said, what you want in a currency in a mode of exchange is consistency. That what I can buy today, I can buy tomorrow. And the world governments really aren't providing that for the euro, the yen, or the dollar. We are trying to devalue currencies to get economic growth. It's hurting the buying power of the average citizen.
Now, when you do have that fiat currency backed by nothing, are these going to be long-term problems globally?
Absolutely. I think what you see in debt, and I think we see it play out in Europe. I think what we're seeing in Greece and what they call the pig nations, Portugal, Italy, what you see is debt to GDP became so large that the economy couldn't grow, that they couldn't fund their government. The U.S. is on that same path. At $17 trillion of debt, the office of, or the CBO, they estimate that our debt's going to be $25 trillion in 10 years. When does it end? And I think that that's going to be the long-term challenge for the U.S. government, is to slow down spending, is to slow down debt creation so our economy doesn't tank.
What do you think happens if the oil for dollar link is broken? What happens to the U.S. if that ever happens?
Right. Well, the U.S. dollar enjoys world reserve status. And as soon as we lose that, then you're going to see a level set or a reset of how the U.S. dollar and the influence we have in the world. So you see it more and more where countries are now exchanging with their own currencies and moving away from the U.S. dollar. I think the U.S. government, I think the central banks should be very concerned about that, because we do have a lot of power by being the world's reserve currency. If we lose that, then I think it's a game changer, and things will change for our economy, things will change for our buying power.
When it comes to gold, when should investors look for that opportunity to jump in and buy?
Right. I've always been a believer of diversification. And I think gold and silver, those are contra assets. So if you're concerned about your buying power, if you're concerned about the dollar, then you want to have assets that really protect you against that. Gold and silver have historically been that. So there's always a time to have it in your portfolio. If gold and silver aren't doing much, maybe your other assets are. So again, diversification is important, whether it's in real estate, equities, and gold. You should have some of all of that. Most people have zero. So that's why I think there's always a good time to have it. Be smart, be prudent. You're not going to pick the bottom, you're not going to pick the top, but you certainly should have some exposure to it.
And finally, for my last question, I wanted to hear your thoughts on this whole Bitcoin bubble. What are your feelings towards Bitcoin?
Right.
Should people invest? Should they not? What should they question about it? What should they like about it?
It's very interesting. Certainly it's getting a lot of press these days. But we go back to the dollar. Bitcoin is another form of currency. And if I'm a company and I'm allowing you to pay for a good in Bitcoins, and it's worth $1,200 today, but tomorrow it could be worth $800, that isn't the type of payment structure we want. We want stability in our currencies. Bitcoin, gold, dollars, whatever it is. Bitcoin's not stable. You don't know what the value is going to be, and I think it's a very dangerous, whether it's a bubble or not, I think it's a very dangerous form of currency until it gets more stability.
Well, Scott, thank you so much for your insight. It was a pleasure having you with us.
Pleasure to be here.